Hi everyone, so welcome to my YouTube channel and thank you for watching. So this video will be on the topic of leasing and leasing as a form of financing instrument, right? I'm Rudy Chia and you're watching this on my YouTube channel, right? And you know, many a time during class when I teach this topic of leasing, there is this common lack of understanding about how leasing can help businesses to do off-balance sheet financing. So in this video I'm going to explain to you what is the purpose of financing and how does leasing operate as compared to traditional borrow to buy financing methods, right? And let's have a look at what we're going to do. Okay, so why is financing so necessary? Financing is necessary because businesses need to acquire new assets, right? Of course, there are other ways of acquiring assets, you know, like we could use cash. Okay, cash to buy, using cash to purchase assets is one of the simplest, right? Very direct, okay? But businesses come to a point where it is quite difficult to use cash to acquire assets, especially newer machines. When businesses need to acquire newer machines, these tend to be, obviously, much more expensive than the older ones, right? So as a result, businesses would tend to have to resort to loans to finance the purchase of new assets, right? And then also more commonly practiced is leasing, right? Leasing offers an alternative to purchasing the asset upfront. So what is the main thing about borrowing to buy? Okay, if we talk about using cash to buy, it's very simple. You know, you pay cash for the asset, that's it, you own the asset. But borrowing to buy is a bit different, okay? It is quite necessary, as I mentioned earlier, for larger purchase of assets. Because larger purchase of assets require much larger cash flows, cash outflows, and the impact is quite great when we talk about using, when we plan to purchase large assets or large value assets. So the impact will rest in the statement of comprehensive income, or otherwise known as the income statement. The impact lies in the interest cost. When you borrow to buy, there is interest cost. And when you borrow to buy, there is a liability. Businesses owe, and businesses are liable to pay the installments over the next 12 months and perhaps for longer term loans, even beyond the foreseeable 12 months ahead. The benefit of borrowing to buy is that the business benefits in terms of enjoying ownership of having the asset, and the business is able to utilize the asset in any way to enhance and operate the business. So let's have a look at what is the net effect of such a borrowing on the financial position of business. Take for instance, a business borrows 4,000 and then finances it through a bank loan at an interest rate of 10% per annum. Now, how would that work? Let's have a look at an example here. Right, here we have a set of financial statements. Right, we have the income statement for the year ended 2013. Now, the business currently has no borrowing, as you can see here, because the interest cost is zero or not. Statement of financial position shows that the business has no long-term liabilities. Okay, the business currently has $5,000 of non-current assets. Okay, that's pretty much about it. Now let's see what happens if we take into account a purchase of $4,000 of additional assets. You'll find that immediately the non-current assets would increase by 4,000 as compared to the earlier example observed. Do you see that? Okay. Now, at the same time, because the business has borrowed to purchase the asset of 4,000, right, we assume that this 4,000 is payable more than 12 months later, so it is long-term liability. So this long-term liability exists immediately the moment the business borrows to acquire the asset. Okay, that's not the end. The business also incurs interest costs, right, of 400. Now, interest cost obviously brings down the bottom line, and this interest cost is payable, right? That increases the current liability, as you see here. Okay, so there is additional interest payable of 400, as well as you can see here, additional interest expense. So borrowing creates a very significant problem. That is, the long-term liabilities of a business immediately increases, right? And this also results in higher gearing levels as compared to earlier on. In the earlier example where you see here, without any long-term liabilities, there is actually no gearing, or if you like the other term, no leverage. Now, which bankers are obviously quite happy to see this, because it means that the business is unlikely to have problems servicing its mortgages or loans. Compared to this situation where the long-term liabilities have increased significantly, gearing has increased, right? To measure gearing, we could use the debt equity ratio, or we could use the total asset to total liability ratio. But the topic here is not about ratios, but if you would like to, you can explore more on this ratios in on your own. So basically, the impact of borrowing is that it results in high gearing, and this is of concern. Why? Because greater gearing levels due to long-term borrowings is of concern to certain stakeholders, right? And when the long-term borrowings are so significant, bankers will start getting concerned whether the business has the ability to pay up, and bankers become very concerned about default risk, whether the business has the ability to ensure that interest and principal can be repaid from time to time. Okay, and that is even more of a concern when interest and principal has to be paid regardless of the performance of the business, right? So as far as the business is concerned, higher gearing levels would to some extent scare bankers. Equity investors likewise would be concerned as well, because they would be very interested to know about the going concern of the business. Would the business be able to remain a going concern into the near future, right? So how would we be able to avoid the problem of higher gearing due to long-term borrowing? Now, businesses have gotten quite creative, or rather some businesses have gotten quite creative. They turn to this thing known as leasing. Now, leasing is a very convenient instrument. Basically, what leasing does is that, take for example, you need a place to stay because you're studying somewhere else, okay? And that, what do? You need a place to stay, and you're going to study somewhere else for a long period of time. The obvious question is that, would you prefer to lease or purchase an apartment? The answer is quite obviously, we prefer to lease, because the only cost is rental, and this rental is for short term. And what happens is that you can rent the place as long as you require, right? And the other benefit is that you avoid and you minimize your cash outflows, which makes it a very interesting proposition to people who are studying overseas, right? Instead of buying an apartment, which will be expensive, right, leasing reduces that cash outflow. Now, if we change the context to, for example, a business, right? Business require machinery, right, for short term. Now, obviously, if you change the whole context to business require machinery for short term, should the business purchase or lease the machinery? The answer is quite obvious. Leasing is a much more attractive option compared with purchasing the equipment or the machinery, right? So leasing has various benefits. One, as you can see, is that there is much lower cash outflows, and that is upfront, right, as compared to outright purchase of an asset, which can be very expensive. Furthermore, to leasing, there is an immediate transfer of benefits associated with ownership of an asset. So the moment you lease the asset, you enjoy the benefits of ownership without, the high upfront costs like down payment and initial deposit. Not necessary. And it's far easier to obtain a lease, especially when a business is facing difficulty in obtaining borrowing, right? During the periods of financial crisis, credit crunch, it can be quite difficult for a business to obtain borrowings, but not so when we talk about leasing, because leasing is convenient, is short term, is a very flexible mode of obtaining use of assets, right? And furthermore, the benefits are immediate. In terms of accounting treatment, if a lease is treated as an operating lease, okay, there is also the finance lease, which we'll talk about it separately. But if a lease is treated as an operating lease, the benefit is that the rentals are just treated as expenses. There are no assets recognized in the balance sheet or the statement of financial position. There is also no corresponding recognition of any long-term liability. In other words, the gearing level of a business is not affected, and which is to the benefit of the business. And also, of course, this gives bankers assurance that the business would have no problems with remaining solvent and remaining liquid. So let's look at another example. Let's say, for example, the business has leased the asset instead of purchasing it. Observe, you wouldn't see the additional equipment of 4,000. You wouldn't see the additional long-term liabilities. There isn't any. Instead, the rentals associated with leasing the asset would fall right under operating expenses. Wonderful. There is no interest cost. Net profits are slightly lower because you're incurring rental costs to acquire the use of the asset. So leasing, and in this case, am I referring specifically to operating lease, benefits the business to a large extent, right? Because it doesn't result in greater amounts of debt or greater amounts of gearing, and the business wouldn't be perceived as having high risk of default. Okay, and surely leasing is quite commonly applied for many businesses, because businesses may lease may lease copiers, they may lease computers for very short periods of time. Okay, especially when they have a special project or event happening. Substance of a lease. Okay, a lease can be classified into an operating lease. An operating lease is essentially a short-term rental agreement. Of course, you can define short-term as up to 1 year or 2 years depending, right? The finance lease, however, is quite different. The finance lease is not as simple as a short-term rental agreement. The finance lease, in substance, is treated or interpreted as financing to purchase an asset, or if you like, the other way to explain it is simply borrowing to purchase an asset. So that's a finance lease. Now, a finance lease will have much greater implications than an operating lease. Right? Obviously, finance lease being treated as a type of borrowing to acquire the asset, the finance lease results in higher gearing levels. And how do we differentiate between a finance lease and an operating lease? Okay, there are various conditions. Okay, but of course, I emphasize is not just those few that I've listed below. Okay, it's not limited to these, but some of the common considerations that we use to assess whether an operating lease is different, or rather how to identify whether a lease is operating or finance. We use the following considerations. One is the length of the lease. Is the lease period as long as the useful life of the asset? Okay, generally, so long as the lease is as long as the life of the asset, we say that it must be a finance lease. So take for example, if the asset has a useful life of 10 years but the lease is 10 years, so that means it is obviously a finance lease. Another telltale sign of a finance lease is whether there is an option to take over the asset for a nominal amount at the end of the lease period. Okay, a nominal amount may be like, you know, a small sum that can be paid to the lessor in order to acquire the ownership of the asset. So that's possible. Nature of the asset. Certain assets are highly customized, highly specific, and when they are so highly specific, it also means that this is also a telltale sign that the lease is very likely to be a finance lease. And there are some other factors that we use to assess whether a lease is operating or finance lease in nature. Right, so the classification of a lease is exceptionally important, because if we treat a lease as an operating lease, the impact is more on the income statement or the statement of comprehensive income. Finance lease, however, has much greater implications, because there would be a non-current asset being recognized as well as a non-current liability. Obviously, the impact is that it could also significantly raise the gearing levels of an entity. So if you're a business, what would you do? Would you prefer to pick a finance lease or just take a loan to acquire an asset? Well, it doesn't make any difference, right? Because both are treated the same in the books, right? But of course, creative businessmen and accountants would prefer operating lease, because operating lease keeps the non-current liability off the balance sheet, right? And which is where we refer to this as off-balance sheet financing, right? That's why there is the word off. Off means it's not on the balance sheet, it's outside the balance sheet. So as a share investor, you will obviously not be happy to know that the real value of the non-current liabilities have been cleverly or even creatively taken off the balance sheet and shown as mere operating expenses in the statement of comprehensive income. So the business, right, if they fail to reflect the lease appropriately, it can be very misleading. So as a user of financial statements, deliberate attempts to practice off-balance sheet financing is surely unwelcome, because it unfairly understates the value of non-current assets and non-current liabilities of an entity. And furthermore, the gearing level is also unclear, because if the lease is not properly classified, the user or even investor wouldn't be able to tell whether the gearing level is at this much or at some other level. Leases have to be accounted for based on economic substance, right, and not legal substance. Now, legal substance is not relevant in accounting for leases, right? So back to this point again. So operating lease simply is short-term rental of an asset, and is never going to fall under the balance sheet or statement of financial position. Rental payments are simply treated as operating expenses. A finance lease, however, is treated as borrowing to acquire a non-current asset. Now that would have an implication of it being recognized as a liability, right? While the asset is accounted for in the balance sheet or statement of financial position, right? So both are quite different, right? I hope that you have appreciated why leasing is such an important topic and such an important area to know about, because leasing allows a business to practice creative ways of managing the balance sheet, which is unhealthy, because any attempts to practice off-balance sheet financing will surely put into danger, right, and also possibly put investors into a situation where they may not be able to properly assess the financial position of the business, right? Furthermore, bankers wouldn't be able to exactly tell how much do the business really owe and how much the business really needs to pay up over the longer term, right? So this is the topic of leasing, and I hope that this has been informative. Obviously, I have not covered the detailed calculation aspect of leasing, and that is also important, right? So, well, I'm Will Chia, and you have been watching this on my YouTube channel. I hope that this has been informative to you. Have a good day, and I would look forward to hearing from you again. Right? Thank you, and